Welcome back to Trendlines over Headlines, the show where we break down the markets with some of the best traders and analysts in the world. My name's Patrick Dunawilla, and I'll be your host. Our guest today is none other than Todd Sohn. Todd is an ETF and technical strategist over at Strategas Research. He's a brilliant analyst and a good friend, so I'm thrilled to have him on the show today. But before we talk to Todd, it's Friday, the markets are closed, so let's take a quick look at how this week panned out. Hey guys, thanks for watching. Just a quick reminder, be sure to click like and subscribe so we can continue bringing you awesome content. Thanks. So it was a pretty dull week for stocks. There wasn't a whole lot of action at the index level. The NASDAQ was the only major index that closed higher. It rose a little more than 0.5%, closing at a 9-month high. Now on the other hand, the Dow lagged, falling a little more than 1%. Taking a closer look at the S&P 500, it only fell about 29 basis points this week, so not much has really changed there. It's been testing resistance around 4,200 for nearly 2 months now, and we haven't seen a decisive breakout or rejection just yet. And not much has changed for the Russell 2000 either. It's continuing to test support around 1,700 with no decisive break or bounce just yet. One of the more important charts to watch in the near term will be the US dollar index. This was its best week since September, right before it peaked. And if you look at RSI, it's showing a bit of a bullish momentum divergence, and it never reached oversold. So if it reclaims that 103 level, it'll likely put some pressure on risk assets like stocks, gold, and crypto. So that'll definitely be an important one to watch next week. Now, as far as sector performance goes, the communications sector was the clear leader this week. Energy and materials were the laggards this week, with both dropping around 2%. Anyway, that's enough from me. Let's talk to Todd. Todd, welcome to the show, and thanks for joining us.
Hey, Patrick, it's great to see you, bud. Excited to be here.
Yeah, listen, you've been reading chart reports since day one. You were my CMT sponsor, so I really appreciate all your support over the years, and I'm just happy that we can make this happen today.
It's my pleasure, bud. You do a great job.
I appreciate that. But let's dive right into the charts. We got a ton to cover. We're recording this on Thursday, May 11th, so the week isn't quite over, but it's been a pretty dull week. You know, so far we're just continuing to test these levels that we have been testing for months now. But when your boss, Chris Verone, was here a couple weeks ago, he said something that really stuck with me, which is, this is kind of a choose your own adventure type of market. And I think he's right. I mean, there's something for the bulls and the bears to like here. So rather than asking you if you're bullish or bearish, I think we should just present the evidence, and we'll let our viewers draw their own conclusions, right?
Yeah, totally. Absolutely.
Anyway, let's kick it off with the broader market. You shared this great chart. We used it for chart of the day yesterday on Wednesday, and it got a lot of attention. So I just want you to kind of provide a little more context to this one. How are you interpreting this one?
Yeah, so as you said, choose your own adventure. We've been range bound on the S&P for the better part of the last few months. And so I wanted to zoom out and find some meaningful statistics to help our clients, maybe take a little bit more of an optimistic view. And I came across that the S&P 500's rolling 1-year percentage change has been negative up until April for 12 consecutive months. So a full year's worth of negative year-over-year percentage changes. And what's interesting is that is historically very rare. 2022 was clearly a difficult environment for equity investors, for bond investors in general. And when you go back and look for similar streaks of at least a year's worth of negative year-over-year percentage changes, the forward returns, once you hit that inflection point of breaking that streak, are all positive. 9 for 9 of the other observations. Now, keep in mind, it's very cycle dependent too. So it was a great signal coming off of the tech bubble lows, off the financial crisis lows, off of the lows back in 1982, but a little more tricky back into the 1970s, right? You look at December 1970, plus 11% a year later, but then you actually ended up having a major correction in 1973 and 74. So I do like this optimistic view from this chart. It's a great stat. It's an interesting stat, but I do want to be mindful of, there's still some choppy waters potentially ahead just based on, perhaps comparisons to the 1970s. I think that some folks like to make.
Yeah, I mean, it looks like 10 for 10 there. The S&P 500 has never been down a year later once momentum kind of flips positive like that after, a year at least of being in negative territory. And, I think it's interesting, though, that you didn't add the average numbers in there. I went ahead and did it in my chart of the day yesterday, and I think the average return is around 12.6%, which isn't too impressive, right? That's kind of in line with average, what an average year does. But I think the bigger takeaway here is that it's not bearish, right? You don't have to look at this and say, oh, this is bullish. But it's certainly not bearish type of price action.
Yeah,
right?
It's all about the probabilities, and
right.
This is a favorable probability. The as you mentioned, the average, but the variance is pretty wide from 2% to 38%. But again, I think it gives us a decent probability for the next year or so.
Right. So nice to see that improvement in momentum. But as far as levels go, are you watching 4,200? Is that kind of your line in the sand, just like everyone else's, or what type of levels are you watching for in the next few months?
For me, I'm actually curious on the upside if we can eventually get over 43.25, forget 4,200, forget 3,900. We're just trapped in this range. If you can get back over that August high, 43.25, that's when things really start to get interesting. And hopefully it's accompanied by good momentum. And I would guess, and we'll talk about this in a little bit, sentiment starts maybe to get a little bit more aggressive, right? The FOMO play might come back, that equities are really finally coming out of this range. But I think for now, it's just chop between whether it's 4,200 and 3,900 or what may have you. It might be less about index levels and more about focusing on your individual stock levels for what that's worth.
Yeah, I think that's a great point. And, breadth has been such a concern lately. You keep hearing that it's just a handful of stocks leading the S&P 500, and it's not necessarily wrong. I texted you the other day when I was putting together the chart of the day, and I was just curious, how much of the S&P 500's year-to-date gain can be attributed to the top 10 stocks. And I forget what it was, but it was something staggering, like around 80%. Is that right?
Yeah, so that number has fluctuated between, let's call it 75 to 90% of this year. Now, the initial reaction, I think, from whether it's market participants, our clients, or whatnot, is a little bit of an agitation. Oh my goodness, there's only a couple of stocks driving the gain. So, number one, it is extreme right now. But when you're dealing with a market cap weighted index, and the $2 trillion companies, Apple, Microsoft, Google, Amazon, are starting to rise, that's what happens, right? This is part of using a market cap weighted index. It does not mean it has to be bearish, right? It just means those stocks are leading. The star players are scoring the most points. So then when this happens, you got to take a look at what we call the bench is doing, right? It's the NBA playoffs. You look at the Knicks last night. Jalen Brunson puts up 30-something points, right? The star player did what he had to do, and then the bench took care of the rest to keep the team or the index afloat. And so now this leads us into the next idea that you have to keep an eye on the equal weight S&P 500 right now. That will give us the tell of whether leadership is ultimately narrowing to mega cap growth stocks like Apple and Microsoft, or is the broader market really starting to sag? And so far, equal weight S&P 500 is a pretty sloppy trend as the NASDAQ 100 has started to pick up. And then I would also keep it on the Vanguard Extended Market ETF, VXF.
Yes, tell us a little bit more about this one.
So I think this is under the radar fund. It is all stocks in the U.S. market, or 95% of them, without the S&P 500. Right. Okay. So the biggest names in there are something like Square and Blackstone and Uber. It is a very interesting index. It's cap weighted, but no name is larger than say 1% or so. So there's no Apple effect or Microsoft effect there. And it's a good reflection of everything else that's going on within the index outside of the big mega cap type names. Also
that one looks
sloppy.
even weaker. Yeah, that one looks even weaker
so
than RSP.
Both of those, if you were trying to gauge the market health right now, because we know what mega cap stocks are doing, these are my two go-to funds. And they haven't broken down, but they haven't made any progress either. And so I think this reflects the frustrating environment that we're seeing from our clients and from when you read headlines and stories and whatnot. So if these start to move down while the Qs break out, that's troublesome. That creates a durability issue to the idea of a new bull market. So I don't want to see, I'm okay if the concentration of S&P 500 is 80 or 90%, as long as these two funds are still going up. But when they go down, that's a different story. That's the major difference here.
Right. And, there has been a lot of focus on that equal weight underperformance. It is a great kind of illustration of market breadth right now and kind of that mega cap leadership that we were talking about. And it seems like equal weight, its relative performance isn't the best timing tool out there, right? You'd think that it would be, but when you go back and look, like we shared this one for chart of the day a few weeks ago, and as you can see, through April, that's one of the biggest margins of underperformance from equal weight that we've seen in the past couple decades. Obviously you had it in 2020 and 1997, but Bespoke pointed out that both of those years after April saw 20% or ended in 20% or more gains. So it might not be this harbinger that everyone thinks, right? What are you seeing on there?
Yeah, and I remember the anxieties over the 2020 spread too. Oh, the market's so top heavy and whatnot. Well, 2021 ended up being a pretty decent year. I know some corners finally topped out and whatnot, but we were okay for then. So it's okay if the equal weight S&P underperforms. Again, it's just a reflection that the preference is up the cap scale. You look at the 1990s, the equal weight S&P underperformed from 94 to about 99, 2000, right? That's years worth. Usually it takes a recession or a significant market correction to finally get the average stock, or maybe even small caps too, to start working again, a little bit of a dash for trash. So I'm okay with it underperforming. And it's right here, it's hard to time. Even back in 2015, that was when FANG was coined, I think, by Kramer. And you saw the equal weight S&P underperform from 2015 to about 2020. So you go through these cycles where the average stock, it'll rise, and that's good, but it will underperform, and that's okay. It may be more difficult for an active manager out there, maybe frustrating for some investors, but it's not unnatural, right? So, ultimately, if you do get a recession or a significant correction, that's when you want to maybe skew to the average stock. But for now, don't drive yourself nuts over the underperformance.
Yeah, it kind of goes back to what your analogy earlier about how it's not necessarily bad to see your best players on the team scoring all the points, right?
Yeah, but that's what they're supposed to do.
Right. So our best players on the team right now, it seems like there is a lot of concern over potentially, concentration risk. And of course, I'm talking about Apple and Microsoft, and we've seen their weightings just get bigger and bigger. And I know you keep a close eye on the weightings within the major indices. I don't think anybody knows the index constructions as well as you do. So should we be concerned about concentration risk here as it relates to Apple and Microsoft?
I think the weight now at about 14% of those two stocks, which is multi-decade highs. It's amazing. It's not necessarily a cause for concern as much as it is a cause for anxiety and tension. And so what this is telling me is you have to do your homework. You need to look within the indices. You need to look at other ETFs besides the S&P or the Qs and say, okay, well, what are these doing? What's the equal-weighted sector ETFs, the equal-weighted S&P? What are those doing? Now, this then turns into a passive versus active discussion. If you're a passive investor, fine. These stocks are in the driver's seat. If you're an active investor, it's really hard to say I need to have a 14% position in two stocks. So I think that makes it really difficult. I do find it amazing that these two stocks are 14% today, and 20 years ago, or even 15 years ago, they were only 3%. And so the S&P 500 is ultimately momentum index. This is the market voting for these stocks. They are in favor of these types of tech stocks. It's a voting mechanism. And so, not necessarily something to fear as much as just saying you got to do more homework than just look at what's going on with the S&P, because it might be lying to you in terms of performance.
And have we ever seen two stocks carry so much weight within the S&P 500?
In the data I have, which is about 40 years worth, no. I've had some clients reach out and say you have to go back to the 1950s and 60s or even the 1930s for something similar. But I unfortunately don't have that data. But you have to think about the Nifty 50 when you had, like your AT&T type old school companies where you had that kind of influence. And eventually maybe that made for a more difficult cycle down the line. But in the data I have, it's just amazing. And it's really come back since a few of those stocks peaked in 2021.
Yeah. So, I want to move on to sentiment here. I know you do a lot of work on ETF flows. So are flows saying anything about sentiment right now?
Yeah. Okay. So I think ETFs are a great tool to help measure sentiment because it shows what investors are doing. And now there's a lot of noise. You get your Vanguard inflow drip every single day. That's pretty normal. But there are other corners that can get very aggressive. A great example was ARK back in 2020, 2021. They were taking in billions of dollars per day. The stocks are getting really extended. I think that was a little bit of a tell that maybe you should take your foot off the gas. So right now, I think sentiment is arguably the best asset this market has. ETF flows over the last 12 months have finally normalized after a surge 2020 and 2021. I think it's interesting that there's been more money into fixed income ETFs this year than equity ETFs. Now there's a whole other story to that. But the flow backdrop is very restrained. Reticent is kind of the word I like using here towards equities. I think a lot of attention. Yeah, reticent, restrained, very restrained. A little fancy word there.
I like it.
Folks are not over their skis here, even though we're 7 months off the October lows, right? The flows are not keeping up with where the S&P is right now. And that shows that there's investor angst and nerves that they're not embracing this move.
Yeah, and I'm sure you've heard it too, this net short position in S&P 500. What do you think of that? Are you seeing the same thing, kind of a crowded trade?
Yeah. Okay. So we have flows that are restrained. I'd also say inverse equity ETF volume is still very high, right? Bets against certain corners of equities. And then we have the futures market. And I know that the chart of the speculative positioning has made its rounds, the shortest since I think 2011, right? And so in this chart, we just took a 3-year Z-score to measure it, to kind of normalize it, and you're 2 standard deviations below on the E-mini S&Ps. And so this is another supportive sentiment data point that the speculative folks, your hedge funds, whatnot, don't believe in equities right now. Now there could be hedging purposes there for all we know. But again, another supportive data point for stocks in the sentiment camp. So I would keep that in mind. That's a good amount to carry us for a little bit.
Yeah, and you called this one the most aggressive flows chart out there. So tell us what this means for sentiment.
Okay, so we know equity flows. We were just talking about that. It is nearly impossible to have a conversation with someone without the word money market funds in it now. Everyone is talking about this. And I get it. You're getting 5%, which you have not on a money market fund, which you have not in 15 years or so. But it is just amazing how everyone is just so comfortable with this. And we've seen AUM in money market funds fly. Usually this happens during recessions, significant market corrections, right? Everyone goes to cash because there's so much fear out there. But it's happening as the S&P, again, 7 months off the low, slightly improving. It's happening at the same time. So there is the yield component. I can get income. I can get 5% on my cash and sit fine. But the anecdotal conversations I'm having is just amazing. Everyone says, I'm good with money market funds. I'm okay there. And so that's what we call it, the most aggressive flows. They're taking in billions by the week. The new data came out today at 18 billion. That's a little bit down from the last few weeks. But it's just incredible how money market funds are back in vogue now, especially given how stocks have improved here over the last few months.
Yeah, and it kind of begs the questions, what if yields do come down a little bit too? How's that going to look, right?
Yeah. I mean, there'll be a rush. The good thing is there's liquidity here, but there will be a rush, I guess, for the exit. I'm assuming. Everyone is perhaps worried about the effects of a recession because that'll bring yields in. So everyone wants to get their 5% now while they can. It's like putting a bowl of candy in front of a 3-year-old after never having candy before. They now have this bowl of M&Ms in front of them. That was 0% interest rates. The bowl of M&Ms is now 5%, and they're just going to town on it.
Well, with 2 little ones at home, I'm sure you're very familiar with that one.
Yep, exactly.
Well, listen, I want to shift gears a little bit away from the broader market, and let's talk about the energy sector. All the focus has been on banks and financials, rightfully so, but energy's been pretty weak, and I think some of that weakness in financials is kind of maybe covering it up a little bit. But, it was the best performing sector last year. It's now the worst performing sector thus far in 2023. So, I've seen a few people starting to get a little bearish on energy, and I'm wondering if you kind of share that bearish outlook.
Yeah, I don't love how the stocks act. I don't love how the XLE acts. Exxon is really the last one to not crack. If you go through all the energy charts, most of them are starting to fall below their 200-day. Exxon is the last man standing, and that's the biggest weight in the XLE, so it's kind of masking what's going on there. And so I don't love that relative performance is deteriorating, but flows out of energy sector ETFs are getting interesting from a contrarian perspective. Now, I do need to see the trends improve from here. But if you're an energy investor or you're bullish energy, this is one thing to say, okay, this is helpful, that there's been a sharp outflows from energy over the last few months. Now, the big picture though, and this is a favorite stat of mine, is that energy.
Yeah, you've been sharing this one since the start of the year.
I'm proud of this one. So energy,
explain it.
From 2020 to 2022 doubled its weight in the S&P because it had such a monster run. Now, it was very low base. It was only 2% of the S&P. That's rare for a sector to get that small. But historically, and another caveat, this is a small sample size, when sectors double their S&P 500 weight in a 2-year time frame, they tend to take the next year or so off. They may correct sharply. They may just float sideways for a while. And I think that's what's going on with energy. So tech was the one that doubled from 97 to 99 and then got hit really bad. But then you look at something like healthcare in the mid 80s or industrials in the late 70s, early 80s, doubled and then just kind of was a market performer, I guess you could say. So energy, I think, is going through something like this right now. Again, small base that it started from, small sample size, but there are comparisons to what's going on here. And so I just think 2023 is a year for energy to take a backseat again. And we'll see where 2024 stands. But this is a stat I have been relying on for energy because I think a lot of folks were very bullish on the sector, policies, whatever you want to call it. And they say it finally coming back, and interest rates going up, that maybe that would help the energy sector as tech takes a back seat. That's kind of been flipped on its head. And so I like that flows tactically are supportive, but there is a lot of damage that has been done to the trends in that sector.
Yeah, I think that's fascinating. I never would have thought to look at, what tends to happen after a sector doubles its weight. And like I said, you've been on to this since the beginning of the year saying, this could be the year that energy kind of struggles after such a strong year that we had last year.
Yeah, it's gravity. Momentum is a great thing until it stops. And then gravity comes into play. People start selling out of their momentum names. And I think that's what seemingly is happening with energy. And just keep an eye on Exxon. And even a BP or a Shell, those are kind of the last remaining mega caps that are cracking. Whereas when you go down the cap scale, there's been a lot of other damage there.
Yeah. And, before we get too far away from the sectors, I'm wondering, do you have any thoughts on financials here? Like I said, everybody's kind of watching that.
Yeah. So we were talking about this stat yesterday. I think it's amazing. JP Morgan's market cap by itself is about 400 billion, or maybe 390 something. That's larger than the market cap of the entire KRE, which is about 140 regional banks right now. So you want to talk about too big to fail is JP Morgan. It's bigger than the entire regional bank space right now because of the significant decline.
Wow.
I am watching the KRE, and I'm specifically watching the volume on the KRE. You've had two significant kind of volume shock days during this episode. I'm wondering if, let's just say KRE goes on to make new lows for the next month or so. Is it on less volume, less intensive volume? Because that would tell me that the sharks have moved on and there's a little bit more apathy. Like, that's old news. We did the damage there. That would suggest to me that maybe the lows are starting to form, right? Less apathetic. That's kind of what happened back during the financial crisis with the XLF. There was these huge volume spikes, and then by the time you got to the 2009 lows, there was much less apathy towards that sector. And I think that's kind of an ingredient involved in a bottom. As for the big banks, they still don't trade great. I don't love that. And that's also part of this equally weighted S&P 500. So don't love how the banks trade. I think it's interesting that international banks, while they're pausing here, have held up way better. When was the last time we could say, there's a financial event, crisis, whatever you want to call it, and European banks are actually trading better than U.S., Japanese banks are trading better than U.S.?
Right, that's an excellent point, yeah.
Yeah, curious. Now, they could all fall apart from here for all we know, but it's just a little bit different than what we're used to. And the other tricky thing, keep in mind with the XLF, is that Visa and MasterCard are significant influences there now. And those names they're definitely better than the rest of the constituency. So again, you got to do your homework. Look at the KRE, look at the KBE, rather than look at the XLF, because now you have these techish consumer type names in there instead.
Right. I mean, the Visa and MasterCard and PayPal too, I think.
Yeah.
They were all in tech sector, and then on that last rebalancing a couple months ago or a month ago, they got added to the financial sector, it seems like that's where they belong. They seem like more financial type stocks, but it could be a good thing for it, right?
It certainly helps. I mean, it's a little diversification. The sectors, GICs, they've been making these changes in the last 5 years. We had REITs, and then they blew up discretionary and added communications. Part of me thinks this is why you're seeing such an explosion in thematic ETFs. Everyone is tired of the GIC structure, and they're saying, well, Amazon is not just a discretionary stock, it's also a tech stock of some sorts, or Apple's a consumer stock of some sort. And so you're seeing all these thematic launches come into play. Even today, a new luxury ETF launched. LUX is the ticker. There's nothing to chart just yet, but if you're looking to play European luxury along with names like Wynn Resorts, or whatever other luxury items you can think of.
I'm going to take a wild guess that LVMH is in there.
LVMH is the top name. I believe Hermes is another top name. Kering, which are clearly driving Europe. But I like now that you have a bit of a blend there, and there's a couple other random thematic plays that are coming that they cross-pollinate all the sectors, and I think those are going to be really valuable for us as market analysts going forward.
Do they have Ferrari in there as well?
Ferrari's in there. Tesla is not, which I find interesting because the average price of a Tesla has been in decline. And to the issuer, I was reading their deck, that's not a luxury item. Luxury items don't go down in price. They only go up in price. So Ferrari's in there. There's a super yacht Italian stock in there, which I'd never heard of actually. I think it's SL space IM is the ticker. I think that's the ticker. And then you got your Euro luxury, and a couple other random U.S. names in there. I can't forget.
And what did you say the ticker for that ETF was?
LUX.
LUX.
So it's brand new. There's nothing to chart just yet. But if you're trying to keep a tab, or you actually wanted to play that idea, take a look at it. And I know I'm talking another issue as ETF, but this is just another helpful data point for us as guys who analyze the market.
No, I appreciate that. And I think your point about JP Morgan's worth reiterating. I mean, its market cap is bigger than the entire KRE, the entire regional banks ETF.
That's wild.
Right. So for all the focus there is on KRE, there should be an equal amount, if not more, on JP Morgan, right?
Yeah.
But before you go, I want to get your take on gold. I was at your office a couple weeks ago. Thank you for the invite, by the way. And one of your sales guys, who's also named Patrick, great name, he asked me for my best idea. And, I thought about it for a second. I just kind of hesitated and I said, I like gold. And I felt a little silly saying that because, we're all watching the same chart. We're all waiting for the same breakout. And we haven't really gotten it yet, hasn't really materialized yet. So what are you seeing from the shiny metal, and do you think it'll eventually break out?
Yeah. And if John Roque is listening, he's talking about Pat Allwell, John, your favorite strategian, and who gives us a lot of laughs.
Great guy.
He's a pro. So gold, beautiful chart. We all know it, right? Trying to break out from this multi-year range and going all the way back to the 2011 highs too. I think some investors may be using it as, a recession play or just an anxiety play. You could talk about the dollar and their role as a reserve currency on it. That's not our business. I find it interesting that gold is testing these highs, but ETF flows, they've picked up since SVB collapsed, but they're not super aggressive like they were back in 2020. So I do think there has been some movement to gold since the bank issue started. But there's a lot more room to go in terms of aggressive positioning on gold. And I think it's reflected in the futures market too. Yeah, some folks are long, but it's not through the roof. Every single one is talking about. And I think a lot of that actually has to do with what money market is doing. There's, I think clients are, they're happy to go to 5% money market funds rather than trying to go for the price appreciation on gold. Now, going forward, I got to keep an eye on the dollar. The dollar's trying to stabilize here over the last couple of weeks. If you get a dollar rally, I think that's going to cause a little bit of an issue for gold as it's around this 2000 level. But ultimately, if the dollar works lower, that should be the catalyst to get gold to break out higher. And in a choppy equity environment, I think it makes sense to just have at least a slice of your portfolio in there, right? If you're worried about equities working forward, okay, well, you have your equity allocation, you have your money markets and your bonds allocation. And I think it makes sense to at least have some gold exposure here, especially as the rest of the commodity space is all over the spectrum. Oil doesn't act well. Some of the ags are down sharply. Some of them are really extended, like orange juice. And so then there's gold. I think it's worth a slice in your portfolio if you're looking to fill a void, and maybe even add a little bit of a recession protection just in case.
Yeah, and if you are a gold bull, what would you want to see from a flows perspective?
More ignorance, right? I just find that this run hasn't been accompanied by major inflows. Yeah, they have picked up, right?
And you're talking about what, GLD or GDX?
Yeah. So not the miners, just the physical, because the stocks, there's other catalysts involved. So I'm talking GLD, GLDM, which is the mini version of gold. It's a cheaper version of gold of GLD. It's like 10 basis points versus I think 40 for GLD. Really? That's getting popular. That's more popular, I think, for buy and hold advisors. It's just cheaper. It doesn't have the liquidity, the exchange liquidity that GLD offers if you're a big player.
Right.
But if you're just looking for the best option for your portfolio or you're a smaller player, GLDM. It's also got IAU, which is the iShares version of GLD, and IAUM, which is GLDM's cousin. And then a few other physical gold related products that we track. I mean, GLD and IAU are hopefully the ones that drive the flows because they're the biggest. But so we have the whole spectrum in there. And this whole run, there's been some inflows here and there, but it isn't through the roof. That could change if gold breaks out. Wouldn't be shocked if everyone starts to become a gold bug again. But the higher this goes without the adoption of inflows makes it an interesting pair from a sentiment perspective. And that's for the value I find in tracking daily and weekly ETF flows.
So you do think of flows kind of in a contrarian way then?
Yeah. And listen, there's not a signal there. It's not like, the 50 crossing over the 200-day, that could be a good buy signal, sell signal, what have you.
Right, but kind of coupling it with price action and seeing how the flows and...
If you're trying to tell a story or you're making a bullish and bearish list for an asset class, ETF flows deserve to be in there. Or is it a corner being ignored? Is it being way too aggressive, is everyone flocking to this corner, and that gives you a piece of the puzzle, a piece of the story that can help you manage your risk. And we brought up ARK before. When you looked at ARK, it was getting super extended. Everyone was talking about it, and the inflows to that fund helped back it up. Similar scenario with equities in general right now. The equities are improving, but the flows aren't really there. And so that's something I can put in the asset category rather than a liability. They're a good piece of the puzzle. Again, not a signal to use, but if you're just doing your full-on analysis and trying to make a scale of good and bad,
yeah, if you're looking for evidence.
Place. Exactly.
Right. Well, anyway, Todd, you and I could sit here and talk charts all day, but we got to wrap it up now. But thank you again for coming on, and hope to talk to you soon.
Thanks, Patrick. I truly appreciate it. It's nice to join you.
Yeah, of course. Have a great weekend.
You too.
Thank you guys for watching. If you enjoyed the show, be sure to click like and subscribe, and we'll see you again next week. Thanks.